Hi, I'm Michele Santangelo. I'm a fund manager with Vunani Private Clients. I'm going to just discuss a little bit more about using a benchmark to measure your performance. So why should you care about benchmarking? Simply, it can alter your financial future. It's actually one of the most important parts of any investment or trading plan, but once again, it's probably one of the most ignored and not clearly understood. And that's why investors probably don't put any focus on it at all. But the most important thing is that a benchmark isn't just for long-term investing. You can use it for short-term trading of single stock futures, geared investments, and also at the same time you can use it for benchmarking or monitoring your long-term investments, whether you're doing them for yourself or whether you're utilizing a fund manager. One of the biggest and most important things about benchmarking is it creates a realistic expectation of your investments. And that's one of the biggest issues that we hear about in the markets, is that investors think they're underperforming because they just look at one particular benchmark, and that's probably not appropriate to them. I've just included a little picture on the bottom right which just shows an investor who's got a target that he wants to jump over. If he gets over that, he's beaten his benchmark, and if he doesn't make it and the bar falls, he's underperformed his benchmark. And I think that's what everybody does do directly or indirectly in the markets, and that's try to beat the target. Basically, what is a benchmark? A benchmark is a measure of the performance of an investment portfolio. Basically, it's a test with which a portfolio, security, fund manager can be measured or compared. So whether you've got a pure equity portfolio of large cap shares, or you've got a single security, the likes of BHP Billiton or Naspers, you can compare those to a group of shares or indexes like the all-share index. You can see how much, for example, Naspers has outperformed the general equity market over the last few years, or you can use it a benchmark to measure the performance of your own fund manager who's potentially investing in stocks for you. In general, we look at varying indexes which are used as benchmarks in South Africa, and these are usually broad market indexes like the equity market, property market, or bond market, or combinations of these. And that's important when you're looking at combinations. It's for diversified portfolios where you've got a combination of equity, property, bonds, cash, or alternative investments all together. You can't just use one particular equity index, for example. You need to use a combination of indexes. When you look at the different kinds of benchmarks, it's important to understand the difference between the two. You have relative benchmarks and absolute benchmarks. On the relative benchmark side, you're always looking to outperform no matter what the market direction is. So, for example, if you're an equity investor and you're benchmarking yourself against what the all-share index is doing, and it falls 5% and your portfolio only falls 2%, you're outperforming the all-share index. So that's a relative benchmark. On the other hand, you do have absolute benchmarks, and this is often used in the hedge fund industry and also in some lower risk portfolios. And that's where you always want to have a positive return. So you never want to have a negative month. And this is typically a cash plus a percentage over a year, or inflation plus a certain percentage. Those are the two most common types of benchmarks that are used, and those are important to give you a realistic expectation of what you or your fund manager are targeting. When you are benchmarking, it's very important to understand your own objectives, which are part of your own investment plan, when choosing a fund manager or choosing your own benchmark. The most common benchmarks in South Africa, and once again, these are set up by your own objectives. If you're a pure equity market investor, focusing on large cap shares, the top 40 index is the way to go. If you're a general diversified equity investor, the all-share index is probably more appropriate for you. And the Swix index is actually one which is most commonly used by equity fund managers, and that just benchmarks their performance versus a offshore shareholder reduced weighting of the all-share index. And that typically just brings down the weightings of the large dual listers, the likes of SA Breweries, BHP Billiton, and the like. If you're an investor mainly focusing on smaller or mid-cap shares, the mid-cap index or the small-cap index is a lot more appropriate for you than the top 40. In the bond market, which is typically for bond portfolios, not really utilized in a retail environment except through fund managers, is the all bond index, and that's a combination of different corporate and government bonds. And then the Govy, which is just a performance measure of the government bond index. On the global side, and we see a lot more interest in this from investors, particularly because the rand has blown out, and that's the most common benchmark is the MSCI World Index, and that's just a measure of the performance of the global equity markets all combined into one index. On the property side, we've got lots of property investors who love listed property and who focus their portfolios to just property investments. And typically you want to benchmark yourself on the JSAPI, which is the listed property index. One thing to really look out for, and that's peer benchmark. So that's the average of fund managers' returns. And whether you've got your own equity portfolio, which you manage yourself, or you have a fund manager, you always want to be able to compare yourself to what the average fund managers are doing. So if you've got an equity fund and you want to compare yourself to the average of the general equity fund managers, it's a good thing to do. You can see how you're doing relative to the professionals. And the next point is a combination. So the next benchmark is combinations of the different asset classes, such as equity, property, bonds, and cash. And as you get older, typically you're going to have slightly increased allocations to property, bonds, and cash, and slightly lower allocations to equity. So it's better to benchmark yourself with a combination of different indices, like the top 40 with a combination of some All-B and some property, just for example. The next benchmark, which is typically used as an index, is the STEFI, and that's a cash index, just a measure of how cash is performing. And typically, once again, you kind of always want to be beating cash over the long term. And that's exactly what the capital markets and the equity markets are there to do. So onto measuring your own performance, whether you're evaluating yourself or your fund managers, the same principle will always apply. And you must always compare apples with apples. And it's an old saying, but that's exactly what you need to do when you are comparing it. Each investment has to be appropriate. Each benchmark has to be appropriate with the kind of investment that you're looking to make. Why do we measure our own performance? Because if you or your fund manager consistently underperform the benchmark, and we do highlight consistently because over the short term you do, everybody can have a bit of underperformance. But if over the long term you or your fund manager consistently underperform, you or your fund manager typically have no investment skill, and therefore should just leave it to the guys who are actually performing. And it's important to do this simply because if you underperform your benchmark by 1 or 2% over a 30-year period, you'll be absolutely surprised as to how big the impact will be on your retirement or on your investments in the distant future. So when you start measuring your own performance, you need to be realistic about the objectives of your own personal circumstances. So typically you need to understand what your own risk profile is. Are you highly risk-taking? If so, then you should be 100% in equities. If you're a very conservative investor, you don't like to see a lot of volatility, you'll probably have a lot less, let's say 40% of your portfolio in equities. So if you benchmark a portfolio that only has 40% in equities to the top 40 index, you're going to be pretty upset because you've got an incorrect match and it's not appropriate for you. When you're measuring your own performance, look at your age. Typically, if you're a young investor in your 20s, you need to have as much equity exposure as possible versus someone who's in retirement who's looking for a greater amount of income versus their younger counterparts. Another important aspect is you need to be cognizant of what your personal balance sheet looks like. If you don't have a lot of investments and you can't afford to take on the risk, then you probably shouldn't be looking at a pure small cap portfolio. So how do you evaluate your own trading or investing? Once again, you need to match your objectives to your benchmark. If you're a large cap equity investor, only focusing on large caps, you're going to look at the top 40 index. If you're a small or mid-cap equity investor, benchmark yourself to either one of those indexes or a combination of the two. And one of the most common combinations is just a 50% performance of the mid-cap index and a 50% performance of the small-cap index. If you're an investor focused on dividend or income, typically you would also look at the Dividend Plus Index, which the JSE publishes, which has a focus on higher paying dividend stocks. And if you're a diversified equity investor who's not really focusing on anything in particular, you're going to use either the All Share Index or the All Share Swiss Index. If you're a pure listed property investor, which there are many of, focus on the JSAPI, the property index. Typically, these are all longer-term equity investments. But if you're looking at more to benchmark your trading or your short-term trading, you can either use the absolute or a relative benchmark. So if you're an ultra short-term trader, you're trading single stock futures or index futures on a very short-term basis, you're probably going to use an absolute benchmark. So you're going to make sure that you're always positive because you can go long and short. You shouldn't really care which direction the market's going. So you want to make an absolute return. If you're typically a trader who looks more at 3 or 6 months investments, you're going to still benchmark yourself to maybe the All Share Index or something similar. The next important thing about measuring your own performance is typically no one manages their entire portfolio on their own. They do have financial advisors and fund managers acting on their behalf. And benchmarking is important because it allows you to evaluate those advisors and their advice as well as the underlying funds. So an advisor who gives you 4 equity funds, for example, to invest in, and 3 of those are small cap funds, and you're looking close to retirement, you can see that the benchmarks will identify the strategy of those funds, and you can then determine if that's actually appropriate for you. The same thing happens when evaluating a balanced fund. If you are typically a low equity investor, you can't invest in a balanced fund which targets a high equity allocation. And typically, the same story occurs when you're investing in property funds. You want to be in. There are property funds that invest in more the larger caps, and then some of the funds that benchmark on the smaller stocks in that property sector. One of the most important aspects of evaluating your financial advice you receive or your fund managers is just to measure on a consistent basis what or how they're performing relative to their peers. So if a fund manager is consistently a top quartile performer, that's a sign of a good quality fund manager. So over a long period of time, that means that they're in the top 25% of fund managers. So typically, if a fund manager is in the top 25 or 50% of performers, you know you're getting a good quality manager and who's potentially always outperforming their benchmark over the long term. One thing to note is every unit trust fund or the like has got a benchmark stipulated on their fund fact sheet. You have to do this by law, and that just helps you identify or match your needs with what the varying benchmarks. So understand what the benchmarks are in the underlying portfolios, because each portfolio or fund, particularly in the unit trust industry, clearly indicate their benchmarks all the time. When evaluating the investments that are made on your behalf, peer review is always a very important characteristic to look at. Top quartile performance or consistent top quartile performance or top 50% performers, those are the fund managers that you want to be consistently investing in. The bottom of the table, you kind of want to avoid or ignore. Just to give you a little bit of an indication of how benchmarks can actually diverge, a lot of investors think, okay, I'm invested in the equity market, I should be performing like the top 40. You're possibly not, because a general equity fund manager might have a mixture of mid-cap shares and shares that aren't focused on the top 40. And that would significantly underperform. We can see the top 40 has outperformed the overall market, the All Share Index and the Mid-Cap Index and the Property Index and the Divi Plus Index by quite some margin, particularly that Divi Plus Index, which is more of an income equity portfolio. So having a different benchmark is very important, because you can see how they can vary, and it gives you a good understanding of what you or your fund manager is targeting. So we've looked at mostly active management, which aims to outperform the benchmark. And once again, if you're trying to outperform something, you're taking the risk that you might underperform, but your reward is outperformance. But the same concept of benchmarking does occur in the passive space. We've got lots of companies actively punting passive portfolios. So I saw last week there was an article in MoneyWeb, and it was quite interesting that there was a whole bunch of the top 40 ETF providers, and compared to them compared them to how their benchmark performed. And remember, passive management simply aims to match the benchmark. They don't try and outperform. They don't try and take any excess risk. They just try and match their benchmark index. And even then, you've seen that there is quite a varying degree of performance and underperformance by these top 40 ETF providers. So it's easier to say the same principle applies there. If you're a top 40 or your ETF provider, whether it's a dividend plus ETF or any other kind of ETF, if they're underperforming significantly, you still need to fire them and find someone else who'll provide a better match to the benchmark. In terms of creating your own benchmark, there is something called the Bailey criteria, and this is a criteria which is internationally known, and it gives you 5 trademarks of what a good benchmark is made of. The first and most important, it must be appropriate. So we've already discussed your objectives and portfolio composition, and your benchmark must be appropriate to what your style is, what your investment looks like, what your risk-return profile is, what your income requirements are, whether you're a low equity investor or a high equity investor. The benchmark must be appropriate to you as an individual. The next point is that your benchmark must be specified in advance. So you need, before you start investing or at a point in time, say, this is my benchmark. Don't chop and change it, because that's not going to add any value to your own investments at all. Also be cognizant of any fund managers that start trying to change their benchmark. So a fund manager who's focused on the all-share index, who changes to a mid-cap index or a combination, he's probably changed his strategy, and that means that you've changed your strategy. The next point is that it must be measurable. So the great thing about the JSE, they publish all these indices on a consistent basis via multiple platforms, and you can easily measure the performance of those indexes, and once again benchmark them to your own investments. The next thing is a benchmark must be investable. And that just means that can you replicate or mostly replicate that benchmark. So the easiest one to compare that to would be the top 40 index. You can typically either go and just buy all the shares in the top 40, which means you only have to buy 40 shares, or you can buy a top 40 ETF and gain exposure to that top 40 benchmark or top 40 index. The next one is, and the final one is, it must be unambiguous. You must know about it. It must be clearly identifiable. And once again, the JSE provides multiple indexes which are clearly identifiable. They've got their JSE codes, they've got their JSE names, and you can easily identify them and consistently compare yourself and yourself to the benchmarks and to your peers. So that's what makes a clear benchmark. Hopefully you'll be able to start your own benchmarking and be able to benchmark your portfolio a lot more effectively now that you know a bit more about what benchmarking is about. So are there any questions out there that can go on? Look.